You can't revalue gold by fiat, by dictate, by order, but what you can do is revalue the dollar, because the dollar is an invention. And really, it's not even dollar revaluation, because if the dollar is an honest derivative of gold, meaning it is backed 1-to-1 by a certain amount of gold that is not messed around with, then there is no revaluation, because if it's a 1-to-1 derivative, then dollar revaluation would be gold revaluation, and you can't revalue gold. The market values it at whatever it values it.
In today's news recap, gold's rally stalls as silver price hits a brick wall. What's next for precious metals? Gold's run to consecutive record highs appears to be stalling as the precious metal ends the week back below $2,900 an ounce on strong profit taking. While gold attracts the most attention in the marketplace, its sell-off is muted compared to silver's disappointing breakout. Overnight, silver futures spiked sharply above $34 an ounce, hitting their highest level since late October. But the rally proved to be short-lived as prices ended below $33 an ounce. March silver traded at $32.58 an ounce, however. The precious metal is down more than 4% from its Friday session highs. Meanwhile, gold is looking to eke out a small gain for the week, just barely notching a new all-time high. February gold futures last traded at $2,896.80 an ounce, up roughly $10 from last week. Philip Streibel, chief market strategist at Blue Line Futures, said that the sell-off in silver has dragged the entire sector down. He added that while it was exciting to see the metal push back above $34 an ounce because of its volatility, the move was too good to pass up for many investors. Silver has had a great run, and for many investors who bought when prices were below $30, this was a great way to end the week, he said. At the same time, Streibel said that easing geopolitical tensions are sapping gold's safe haven appeal. Before we show you more clips, smash the subscribe button and check out our huge discount on NordVPN, the fastest and most reliable VPN on the market. This VPN service is a perfect fit for smart stackers who want their privacy protected and don't want their data compromised by prying eyes. For less than the price of a cup of coffee, secure your internet access and get 3 free months with our promo. Believe me, the only problem you'll ever have is that you didn't get it 6 months ago. Let's get back into the episode.
All right, peoples, this chart I got from Daniel Oliver of Mermacan Capital, his latest piece, which is called Gold Revaluation, which is an Orwellian term for debt revaluation. But anyway, he has this chart. And I say here that gold revaluation, in quotes, doesn't revalue gold. It revalues the dollar, which is mostly Treasury debt. Here we have gold as a percentage of Federal Reserve assets. When people talk about the price of gold and has to back all dollars, what they really mean, even though they don't mean it, is that it has to back all base dollars. The Fed is responsible for printing base dollars, and then those dollars go into the banking system, and the banks can pyramid more debt on top of that dollar debt that is owned by the Fed. But when we're talking about a 100% backing of the dollar, we're not talking about the M2 money supply. We are talking about the Federal Reserve's balance sheet. So up here is 100%. Let me move my beautiful face out of the way. 100%. We reached 100%. We actually reached 130% in 1980. We did reach the 100% mark, meaning the market price of gold in dollar terms was able to back the Federal Reserve's assets by 100%. It was actually above 100% when we reached 872 on the morning of January 21st, 1980. We hit 130% backing, and from there we've headed down ever since. You can see where we are now. We're at about what is it, like maybe 5, 6, 7% gold backing at the current market price. So there's a long way to go for the gold price here in dollar terms. This is the statutory rate at $42.22. It's now at 0.1%. So there is plenty of room to go on gold, and it's not too late to buy. That you can see here. If you go to the next slide, this is what Daniel Oliver has said in his latest publication called Gold Revaluation. The link will be in the description below for those who want to read the whole thing, and I highly recommend it. So this is the self-destruct. Talk about auditing the Fed. There's rumors of Ron Paul maybe auditing the Fed. Elon Musk is supporting it, but you should know that auditing the Fed will be the prelude to ending the Fed. And ending the Fed means ending their unit of liability, which is colloquially known as the US dollar. Ending that unit of liability will leave the purchasing power, everyone who has those things, down to zero, and they will be left with whatever physical assets they have left. So it will not be painless ending the Fed. It will be very painful for a lot of people who own a lot of the Fed's liabilities, meaning if your bank that holds your deposits goes bust, then you have no more deposits. And if there is nothing to bail them out with, you will lose your deposits. So the end of the central bank means everybody loses their dollars. So what does he say here? This is very exciting. It's also very scary. Just because the Treasury will instinctively defend the Fed does not mean it will not eventually surrender to the market, however. Indeed, says Daniel Oliver, if defending the Fed allows Congress to continue its profligate spending, then, like the gold pool in the 1970s, the Treasury's efforts will unleash the financial forces that will overwhelm it. This is when the legal distinction between the Fed and the Treasury and owning gold versus owning a claim on gold will manifest. What he's talking about here is the Fed does not own the gold that's on its balance sheet. The Treasury does. And this puts a fork, a wedge between the Fed and the Treasury because the gold is on the Fed's balance sheet, but the Treasury owns it. And when both institutions are in a lot of trouble and they both need the gold, the Treasury has dibs on it because they actually own the gold, whereas the Fed only writes claims to the gold on its balance sheet. That's what he's talking about here. And what he's essentially saying is when their balls are to the wall, whatever it's saying is.
In today's news recap, JP Morgan and other big banks are flying billions of dollars worth of gold on planes. JP Morgan Chase alone plans to deliver $4 billion of gold this month, according to security filings. Trump's tariffs are already having unintended and somewhat strange economic repercussions. For example, they have led to big banks transporting billions of dollars of gold via commercial planes from London to New York City. The price of gold, which investors tend to buy during times of heightened risk, has been on the rise. Gold futures, contracts for the future delivery of gold at a set price that trade in New York's commodity exchange have risen 11% this year and closed at $2,909 a troy ounce on Wednesday. The Wall Street Journal reports that some analysts project that future contracts could soon reach $3,000 for the first time. However, following Trump's election and his threat to impose tariffs on Europe, the price of physical gold in London has been trading about $20 lower since early December. Normally, prices in these two markets move in sync because traders can ship gold between them whenever there is a price gap. Banks play a big role in these markets by holding gold bars in London, lending them out to earn returns, and protecting themselves from potential price drops by selling futures contracts in New York. However, banks that had sold gold futures are now facing losses as U.S. prices surged above those in London. Rather than buying back futures at a loss, they have a better option: shipping physical gold from their London reserves to New York to fulfill their contracts. This move allows them to avoid losses on their earlier bets and even make a profit by selling additional gold at the higher U.S. price. This gold rush has triggered a logistical nightmare, with some clients waiting up to a week to retrieve their gold from the Bank of England's vaults. Additionally, COMEX contracts require gold bars to be a specific size, forcing traders to send their gold to refineries for recasting before shipping it to the U.S. Finally, the cheapest and safest way to transport such large amounts of gold is via commercial flights. According to the Wall Street Journal, banks are using security firms to move the gold in armored vans to London's airports. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
The Treasury will seize the gold. Next sentence here. The U.S. has already allowed two previous central banks to dissolve. That was under, I forgot who, and Andrew Jackson. I forgot who the first one was. Was it Hamilton? I think it was Hamilton. The other one was Andrew Jackson, the closest we had to a libertarian president ever. Why not shutter a third central bank if supporting it becomes too costly to maintain? Because the Fed is a creature of Congress and the Treasury is part of the government, the Fed is only a creature of it. The Treasury has priority on the gold that is supposedly in Fort Knox, and let's not discuss whether it's actually there or not. I really have no idea. Next paragraph, and this is the scary one. And what a wonderfully populist move it would be to allow the Fed to fail. The U.S. could issue currency directly in the form of gold-backed Treasury notes and allow the Federal Reserve note to disappear. The indebted will be relieved, obligations to foreigners will be wiped out, wealth will be redistributed toward the productive and away from legacy holders of claims on assets, and the debt system that enriched the few will disintegrate a modern jubilee. This is more or less what an uncontrolled unwind of the dollar system would look like. Perhaps not a terrible outcome for a populist like Trump, though it would come with much risk and collateral damage, such as the end of the U.S. empire and exorbitant privileges. This will be a very painful process. And however it happens, the remaining purchasing power will be shunted into gold and silver. Now, what Murmacan is saying here, what Daniel Oliver is saying here essentially, is that the Treasury could restart a currency system based on the gold that it owns in Fort Knox and redistribute a currency based on that. That would be a kernel with which to restart a division of labor, but anyway, let's continue here. There are fewer bills being issued now. Bills are the short-term debt that allows the reverse repos to come out into the banking system. This is a different topic now. This is an article from Bloomberg. Fewer bills are being issued thanks to the debt ceiling getting closer and closer and them running out of extraordinary measures, extraordinary accounting measures. So here we have the Treasury bill. It has peaked. That is the amount of Treasury bills outstanding. It's about 6.5 trillion. It's not going to get any higher, and that means that reverse repos are headed back up. This is a paragraph from that same Bloomberg article, link in the description below if you want to read the whole thing. This will suck out liquidity and speed up the final crunch. This is what I said a few videos ago, that the spending cuts by Doge and by Musk are great, but they will speed up the final liquidity crunch. This is the key paragraph. Treasury is starting to trim supply, meaning bill supply, as the tax date approaches and as the debt ceiling constraint becomes more binding, said Gennady Goldberg, head of U.S. interest rate strategy. It's a great name for a debt guy, Goldberg. Rate strategy at TD Securities. We expect bills to gradually become more scarce as the debt ceiling becomes more binding. Richening. Is that a word? Richening? It's enriching, right? You can say that both. Richening, enriching. Bills and likely increasing the use of the Federal Reserve's reverse repurchase agreement facility, meaning if they don't issue more bills, there is nowhere else for that money to go except back to the Fed into the reverse repo facility, and that is what is probably going to happen. And as the money goes into the Fed, it goes out of the banking system, decreasing liquidity, increasing the probability of a final dollar crunch, which will eventually happen anyway, and this could be the cause of it. This is probably as low as we'll get for the reverse repos. We're at 67.67 billion. That's a perfectly symmetrical number. I like it a lot. I don't think it's going to get much lower than this, and it's going to head back up now until the debt ceiling is raised, and it's going to cause the final crunch, I believe. Also, a lot going around about the GLD and SLV ETFs, about borrowing rates, about a short squeeze, about this and that, but let's look about what's going on with these ETFs as gold is flowing from London and Switzerland into New York, and that flow has not stopped yet. What is happening to these ETFs? Well, back in 2020, when gold was flooding into New York, it was flooding into the ETFs. Now it is flooding out of the ETFs. We saw that yesterday, actually, a decrease of 170,000 ounces. You can see here, negative 0.17 million ounces. That's 170,000 ounces. And I put a red line here for the amount of gold that was drained out. You can see the red line going down here. So this is gold going out, and this is the third biggest GLD redemption this year. So gold is headed out of this ETF, even though the gold price is headed higher, meaning the retail market is really not interested in this rally, which is a good sign that it will continue. And also, you can go into SLV. Last week was actually the fourth biggest silver redemption day. One day last week, I don't remember which day it was. The fourth biggest physical silver redemption day in SLV history. This is all of the history of SLV going back all the way to 2006. I drew a line here where the latest redemption was over here, and this end of the line here in the right side in 2025. And you can see there were only bigger redemption days in 2008, right before the financial crisis, in 2011 at the silver peak in May, and right after silver squeeze. Here's silver squeeze right here, and these incredible increases in the SLV physical silver holdings. If that was legitimate or not, I don't know. You can do your own research and have your own opinion. Those are the only times when we had stronger redemption days of physical silver. So there's a big demand for physical silver, not so much demand for SLV.
If you resonate with Rafi Farber's perspective on the looming collapse of the US dollar and the critical role of stacking gold and silver as a hedge against economic uncertainty, we'd love to hear your thoughts. Are you preparing for what's ahead by stacking? And more importantly, are you bullish on gold and silver for 2025? Let us know in the comments below. Your insights could inspire others in the community. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.